Welcome friends to the NPTEL module on international trade theory and empirics. We are on the verge of 11th week of our module. I hope you guys are going through the international trade theories and its strategies very carefully. In this last couple of weeks, we will be emphasizing, or we are emphasizing on what is called open economy macroeconomics, their dynamics and adjustment, especially price adjustment, quantity adjustment with the existing fixed or flexible exchange rate regimes. So, that adjustment is very important. And that has a number of repercussions on our balance of payment, on our further exchange rate market. In this pretext, I just wanted to give you the backdrop of our discussion, that the nation's current account is affected by the price changes due to the change in the exchange rate under different exchange rate regimes, maybe flexible and fixed exchange rate system. But as you all know that flexible exchange rate system where the depreciation really works and its impact are visible, are understood for short run as well as long run. But in the fixed exchange rate system, usually we go for devaluation, instead of depreciation. And this is in fact this particular discussion is part of the discussion of the open economy macroeconomics that we already mentioned. So, exchange rate replete mostly in the financial market or in the financial segment rather than trade flows, especially in the short run. So, what does this mean? It means that the exchange rate that is determined mostly derived through the financial transaction than that of the trade related flows or transactions, especially in the short run, but in the long run all are important. Now, question occurs that trade flow do have a strong effect on the exchange rate in the long run. Now, this is another important aspect we need to take a note of it for sure. And what are the important point I mentioned? Trade flows and financial flows. Financial flows for the short run and trade flows for the long run. Now, in the real world, both the international financial and trade flows jointly determine the rates of exchange, but a fully acceptable theory on this has not yet been explored. As mentioned by Salvatore in his book on international trade. Then also cited many references. We are also citing Salvatore's explanation, since Professor Salvatore is one of the pioneer in the international economics and its debates and discussions and analysis. So, coming to understand the implications or the adjustment of fixed and flexible system for exchange rate dynamics on price adjustment in particular, we do have certain assumptions to carry to gauge the exact interpretation. So, the first assumption is there should be no international capital flows, to understand the impact carefully. So, though no autonomous international private capital flows is allowed, this is considered as an assumption. Now, in the second important assumption, we wanted to mention that this international capital flows, that is autonomous, take place only as passive response, not as an active response, and that too it is covering the temporary trade imbalances. So, it is not creating a permanent or a perennial or a long term imbalances. Therefore, international capital flows is assumed to be passive. Now, the next one is that if the nation wants to correct a deficit in its current account balance by the exchange rate, then by the exchange rate changes, then the international capital flows actually works. Okay. So, to understand where does the correction still lies, we wanted to consider international private capital flows to be passive. All right. Now, so there are two regimes we wanted to discuss. In the first, we will take off the discussion on flexible exchange rate, where the price adjustment mechanism relies on depreciation and devaluation of currency to adjust current account and its balance of payment. Now, regarding the income adjustment, then that of the price adjustment, that is relied on the income change in the nation and abroad to make the adjustment. But whereas the price adjustment mechanism relies on the depreciation and devaluation of the currency. But income adjustment relies mostly on the change the nation and abroad to make the adjustment. Okay. So, also two aspects we mentioned so far. Third one is also relevant, that is called elasticity of demand and supply. Okay. We will also discuss the stability of the exchange rate through elasticity of demand and supply, that is determining the effectiveness of the adjustment mechanism. Okay. Through we will be discussing the role of elasticity of demand and supply through the Marshall-Lerner condition. Okay. Now, coming to I will first of all to explain the balance of payment adjustment with exchange rate changes. I will first of all take take you to one blank sheet and to explain that. Okay. That here in a two dimensional structure, we will draw the draw the exchange rate, demand and supply of the exchange rate. Let us for Indian context, that the example which has been cited here is for American context. So, let us we demand a dollar, okay, and the exchange rate we will mention the relative or the exchange rate we mention is rupees to dollar. Okay. Now, based on this, we can find out that over the time. So, we will take time period on the likewise this we will take time period time period and its interpretations, how much dollar the country actually demands, and also how much stock it has is very important to note. Okay. Now, let us just draw the diagram. It is the supply of foreign exchange, and this is the demand for foreign exchange. Okay. Now, likewise this I am also putting the same thing here. So, here it is what we demand and what we supply in order to understand the implications in the exchange rate. So, demand for dollar and supply of dollar. Okay. Now, we get certain information about it. This should be the ideal equilibrium condition. Okay. Let us carry with the same amount as mentioned here, the same number I am mentioning, it is little bit okay, 8, 10 and 12. So, I will clarify again, this is 10 and let us 10, 11, 12, let us have a point somewhere here, it is 12 and this is somewhere here 8. Okay. 8 may be billion dollar. Let us plot it, let us plot a point here. Now, from here we will draw another diagram that will explain another equilibrium point, and that might correspond, that may not correspond, but let us to go by this approach. I am just putting it let the exchange rate be okay, be 1 1 here. Okay. That means what? So, $1 is replaced with 1 rupee. okay, which is generally which has not been the case, but in the example they have taken euro with dollar. The equality is possible, that is a stable dollar and euro value is possible, or exchange rate is can be equated to 1. Now, when exchange rate is equal to 1, what exchange rate is equal to 1, what really is visible in the domestic market, that is in Indian market, that given certain value of elasticity of demand, we are also referring value of elasticity of demand here, value of elasticity of demand. In the first case we have taken the value which is greater than 1, okay, or greater than that of the another demand curve, that is, let us examine elasticity of demand epsilon ED of dollar rupees dollar exchange rate, let it be rupees dollar exchange rate is greater than 1, okay. So, this is what we are referring, and where we are saying it is elastic, all right. Then in this case, when it is elastic, in the country it has been observed that the demand exceeds the supply. Supply means the stock of dollar within the country or the stock of reserves of foreign currency within the country. So, there has been the deficit of 2, there has been deficit of $2 or billion dollar, let it be in billion, let it be in billion, okay, billion US dollar. India purchased at 8 and India actually demand 12. So, 2 more at this rate, India really demands 2 more $2 billion extra from US. But how it is possible? So, when this is the case, that means we are demanding more of dollar, that means our import demand is higher, that means our export is comparatively lesser than that of import, okay. There are so many interpretations to it. So, import is exceeds that of exports, okay, and then what is that? So, through this dollar is demanded more, demand for dollar exceeds demand for rupees, okay. Now, how to therefore, there is a possibility of upward movement of the exchange rate. Now, how to bridge this gap? Import demand should be reduced. So, how it could be possible? If and only if we can able to depreciate our currency, depreciate or devaluate the rupee, that is rupee to dollar, okay. That means, if it is 1, if we can make it more than 1, in our example it is I think 1.20. So, let us go by the same example here, where both are equalized, okay. So, let us go by 1.20 only if there is a 20% depreciation. So, if depreciation is of 20%, 20% of okay. So, if there is a depreciation, if it is reduced by 20%, okay. So, 20% depreciation leads to some adjustment in the international market through its balance of payment. Now, what I wanted to mention, that when we reduce the value of currency, value of rupee as against dollar by 20%, so rupee is becoming cheaper as against dollar. So, dollar is becoming expensive. That means, which one is expensive? Dollar is becoming more expensive as against rupee, expensive against rupees, okay. All right. So, that has led to less demand since we are supposed to pay for the imports. So, now our imports are expensive. Imports are expensive. Okay, imports are expensive. So, we will reduce imports. Okay, reduce imports. When we are reducing imports, this has again led to less demand for dollar. Okay. So, if there is less demand for dollar, then what is going to happen? In that case, we are demanding lesser. So, demand is becoming lesser, and and since since comparatively our import reduces, in reverse export increases. So, comparatively we have more exports than that of imports. So, we may reach at an equilibrium point. So, this equilibrium point is possible at a certain price, let it be, it is 1.20. Okay. So, that is one case. Now, now let us go by some other aspect, like if what I wanted to mention, if the elasticity of demand is not greater than 1, if it is less than 1, elasticity of demand rupees to dollar is less than 1, demand as well as supply, elasticity of supply rupees to dollar, if it is less than 1. Let us maintain this and pinpoint 1 to 2 here somewhere, let it be here. We are just mentioning a point, and accordingly we will draw the supply curve, and also accordingly we will also draw the demand curve. Okay. So, let this be new demand curve, let this be this is the new supply curve. New in the sense we are referring to another context which can be defined through inelastic demand. If both are inelastic, then what really happens? When the elastic demand is inelastic, then as per our standard microeconomic theory, we know that in microeconomics we know that when the market is elastic, the price is expected to be lower. When the market is inelastic, or the demand and supply is inelastic, price is expected to be higher. Okay. So, in this context let us first come to the inelastic structure as a comparison to the elastic demand structure. Now, what really happens? As per this figure and this model, at the at the revised depreciated rate, that is 1.20, revised depreciated rate of our exchange at 1.20, given the market condition to be inelastic. Okay, given the market condition for which is represented by demand and supply, D prime and S prime is inelastic, then even if you have depreciated by 20%, is not going to define equilibrium in the foreign exchange market. How come? Because this depreciation rate now still created a gap in the equilibrium. This is a gap of around 9 to 11. So, it is 8 to 13 was there. So, earlier it was 8 to 13, 8 to 12. So, 4 units were there, 4. Okay. So, 8, 14, 4. Now, here it is 9. So, it is 2. Okay. So, still $2 billion is over demanded within the economy, given the fact that our elasticity of demand for foreign exchange as well as elastic supply of foreign exchange in inelastic. When it is inelastic, the extent of depreciation is expected to be higher, and that has a repercussion in the rate of foreign exchange. So, I mean it has been observed, or this is purely theoretical. Now, what I was saying, if it is 2 somewhere $2, if the depreciation is its value is by 100%, if there is a 100% depreciation, that has again equated or created balance in the foreign exchange market, forex, given the fact that this market exhibits inelastic demand and supply of forex. Okay. So, this is quite important to note. Hence, the 100% depreciation is defining the equilibrium in the inelastic structure, but only given the elastic structure, the equilibrium exists at 20% devaluation, but in inelastic set off or inelastic pattern of the foreign exchange market, the equilibrium exists at 100% devaluation, that is with exchange rate is equal to 2. Okay. Now, what we have seen that the 10 is the equilibrium quantity of billion US dollar demanded as well as supplied within the domestic country is equated in both the market, both the nature of market or the segmented market differently. In the inelastic structure, it has impact on the price, that is the exchange rate increases to double or higher than that of the elastic structure. Okay. So, this is very important to take a note. I think I have explained everything. Now, we can equate to other details from this diagram. Okay. Now, assume that the US and the European Monetary Union are the only 2 economies in the world. Okay. That is the assumption, very important. Okay. Otherwise, similarly, whenever we discussed 2 economy, that is India and US, if you are also assuming that there are other economies that might create problems, and there and a most important assumption we have already taken is that there is no international capital flows, okay, international private capital flows, no autonomous private capital flows we have already mentioned. So, that the equilibrium only explain the change in demand and supply of euro in the goods and services. In our example, the equilibrium of rupee and dollar could be explained through the movement of demand and supply of its foreign exchange, if there is no other forms of capital flows or there is no international economies beside the 2. Okay. So, as we already mentioned, at exchange rate equal to 1, the quantity of euro demanded is 12. Okay. This is what I have already explained in this diagram. This is the 12 we already plotted based on that original diagram. So, the quantity of euro demanded by US is 12 billion euros per year, while the country has supplied only 8 billion euros, it is marked here. Okay. Now, there is a gap of 4 billion euro, all right. So, US is hence on a deficit of 4 billion euros in its BOP. With a 20% depreciation or devaluation, the dollar that is the devaluation of dollar, that now the exchange rate increased to then 1.2 as we already mentioned. So, it is equated to this level. Now, that has completely eliminated the deficit which we have marked in our dollar and rupee exchange rate equilibrium condition. If the US demand and supply curves for euro were less elastic as indicated by D star, D star, it is marked here, and A star. We took S prime, but star is more appropriate because it is not a shift, it is not a change, rather we are referring to another context on the same diagram. Okay. Given the change or given a different type of demand and supply curve for euro, where less elastic as indicated by D star and A star, this 20% depreciation would only reduce the US deficit to 3 billion. Now it is marking at 3 billion, it might be plotting here and it is plotting here. So 8.5 to 11.5. Okay. So it is around 3 billion US, 3 billion euro still under deficit, and a 100% depreciation actually eliminate it completely. 100% depreciation, that means from 1 to 2, okay, the depreciation is now eliminating and there is an equilibrium in the market. Now in the inelastic set off, the market is corrected, but there is a compromission of the exchange rate. Alright. So, this is what I said, we have compared the elastic versus inelastic set off. So, we got the idea that in case of inelastic structure, the exchange rate depreciation is higher than that of the elastic structure. Okay. Now, coming to the derivation of US demand and supply curve for foreign exchange market. Here on the left panel we have US import. Similarly, you can discuss about Indian import and export market. So, on the left panel it is US import market, and where the demand for import and supply of import is mentioned, and an equilibrium point is defined at B, okay, or B prime. All right. Now, given that condition, our price of import in terms of euro is at 1, and we are demanding 12 billion units of euro. Okay. So, import demand for euro is 12 as per our earlier example only. Now, with that is demand for import at the exchange rate, that is 1. And supply of import in the left panel that we discussed, price of import is equal to 1. So, that is 1 euro, and quantity of the euro demanded is 12 billion units of euro per year. With a 20% depreciation that we have said, now we have taken a structure where we are considering price of euro as compared to price quantity of euro, that is demanded. Okay. If there is a depreciation by 20%, then there will be a shift of the demand curve, because this is not a change in quantity demanded argument, there should be a shift. It is completely different than that of the structure we are presenting. With a 20% depreciation, as we already mentioned, now the DM curve will be shifted backward, because the price of the European products are becoming expensive, and so therefore, the demand for import is shifting backward or downward. Okay. That has led to an decrease in the price. Initially it was higher, the price of import is now 0.9, okay, and price of import is now in terms of euro is 0.9, and quantity of import is now is 11. All right. So, now what is in the right panel? So since it is the new PM is 0.9 and new QM is 11. So, this is what we have discussed earlier. Now, in the right panel with DX and SX, DX and SX, that is demand for exports and supply of exports. Okay. We are now referring to the export market. So, left hand side we discuss about the import markets. In the value of import market is declining because of the rise in the exchange rate. So, the new price is quoted at in 0.9 and new quantity that is demanded due to imports is 11. Okay. But in the export market, at the same exchange rate, that is 1, starting with 1, okay, what really happens, Px is equal to 2 euro, price is equal to 2 euro and the quantity equal to 4. Okay. This is the one, all right. So, that the quantity of euro supplied to US is 8 billion euro. Okay. So, so 4 into 8, that is 8 billion euro. So, it is now with that 20% depreciation of dollar that we have already discussed, since dollar has been depreciated, it will from for more exports. So, the supply curve shifts downward, that means it is a rightwards shift. So, like this. Okay. Then the Px is becoming 1.8, all right. So, more supply is there and Qx is equal to 5.5. So, that the quantity of euros supplied to US rises to 9.9, 9.9 billion euros. So, this is what we presented the same thing, but in a different desegregated manner and explaining the derivation of demand and supply curve in the foreign exchange market. Now, coming to the effect of exchange rate on domestic prices and the terms of sale, the greater is the devaluation or depreciation of the dollar, greater its inflationary impact. Okay. Okay. So, because the imports are becoming expensive. And the less feasible is the increase in the exchange rate for correcting balance of payment deficits. Now, depreciation of currency increases prices of both exports and imports in terms of domestic currency. Okay. So, terms of trade can rise or fall or remain unchanged depending on the relative magnitude of that prices. So, magnitude or the responsiveness is important. So, demand and supply of these is very important. Okay. So, these are all the details so far as adjustment of price is concerned in the exchange rate market in the open economy macroeconomic structure. So, we will carry forward further discussion on stability of it through Marshall-Lerner condition in our next class. Okay. With this, I think I should close here. I open your discussion and participation in the next class. Thank you.